Welcome back to MBA Recaps, the podcast that distills the most powerful lessons from business school without the crushing tuition fees or the jargon-laden lectures. Here, we break down the strategies, principles, and mental models that shape the business world. Isn't it strange how the biggest moments in history, the ones that shake the foundations of our world, always seem to catch us off guard? Like a rogue wave in the middle of a calm ocean, they crash into us without warning, leaving devastation or opportunity in their wake. We act surprised, scramble for explanations, and then, as if in a trance, convince ourselves that we should have seen them coming all along. But could we? Should we? Or are we just clinging to the comforting illusion that the future is predictable? This is the uncomfortable truth Nassim Nicholas Taleb unravels in The Black Swan, a book that doesn't just challenge the way we think about uncertainty, it demolishes it. Taleb argues that the events that shape history, business, and even our personal lives don't come from careful planning or slow evolution. They come from the unknown, the improbable, the impossible, until they happen. Take a moment to think about it. The biggest financial collapses, the sudden rise of billion-dollar empires, revolutions, pandemics, technological breakthroughs, none of them were forecasted by the so-called experts. No economist rang the alarm bell before the 2008 financial crisis obliterated global markets. No intelligence agency anticipated that a single, random fruit vendor setting himself on fire in Tunisia would ignite the Arab Spring, toppling governments like dominoes. No one, not even the most sophisticated health organizations, predicted that a microscopic virus from a live animal market would shut down the entire world overnight. And yet, in hindsight, we stitched together neat, logical narratives, convincing ourselves that these events were somehow inevitable, as if history were a puzzle waiting to be solved instead of the chaos it truly is. But why do we keep making the same mistake? Why do we trust forecasts that fail us time and time again? Why do we bet our businesses' investments and even our lives on models that crumble under the weight of the real world? Because certainty is seductive. Because the human brain is wired for patterns, for order, for explanations that make the world feel controllable. But reality doesn't play by those rules. The most powerful forces shaping our world are not the ones we expect, they are the ones that blindside us. And here's where it gets interesting. If we can't predict these events, does that mean we're helpless? Absolutely not. It means we need to stop playing defense, stop clinging to fragile illusions, and start building systems that thrive in uncertainty. Because while black swans can destroy, they can also create. The internet was a black swan. So was penicillin. So was Bitcoin. The same unpredictable forces that wipe out industries also give birth to new ones, rewarding those who are prepared, not with forecasts, but with resilience. So if you're still following the script, trusting the experts, playing it safe, believing that tomorrow will look like today with a few minor adjustments, you might want to reconsider. Because the real world isn't a spreadsheet, it's a battlefield of uncertainty. And the biggest opportunities won't come from where you're looking. They never do. Why do we keep getting blindsided? Why, despite our advanced models, data, and so-called expertise, do we fail, again and again, to see the biggest events coming? The answer lies not in the world itself, but in how our minds are wired. We aren't just bad at predicting black swans, we are delusional about our ability to do so. We misinterpret history, distort probabilities, and cling to illusions of control. The most dangerous part? We don't even realize we're doing it. The hindsight trap, the lies we tell ourselves. Imagine a crime scene. The detective arrives after the fact, carefully reconstructing what happened, piecing together clues, forming a logical timeline, crafting a compelling narrative. But here's the trick. The detective already knows the ending, and that changes everything. This is exactly what happens when we analyze major events. After the stock market crashes, after a war breaks out, after a startup disrupts an entire industry, we look back and explain it. We find reasons, patterns, warning signs. We tell ourselves that the clues were always there and that we just missed them. But this is an illusion, a psychological trap known as hindsight bias. Think about the 2008 financial crisis. In the aftermath, economists, journalists, and politicians dissected every detail: reckless lending, bad risk models, government missteps. Suddenly, the collapse seemed obvious. But if it was so obvious, why didn't they warn us before it happened? Why did those same experts fail to act when it actually mattered? Because the past always looks predictable, once we already know what happened. This is why history books are so deceptive. They make it seem as though events unfolded in a neat, logical sequence, one domino knocking over the next. But history isn't a straight line. It's a chaotic explosion of randomness, full of missed signals, lucky breaks, and unintended consequences. The seduction of experts, why the people we trust are often the most wrong. You would think that in a world driven by data, technology, and sophisticated models, we'd be getting better at predicting the future. But we're not. In fact, some of the worst predictions come from the people we trust most. Economists, financial analysts, political strategists, intelligence agencies, tech visionaries. Why? Because expertise in stable environments does not translate into expertise in uncertain environments. A meteorologist predicting tomorrow's weather? That's fine. Weather systems follow patterns, and short-term forecasting works reasonably well. But predicting where the economy will be in 5 years? That's a completely different beast. Markets are driven by human psychology, government policies, global shocks, factors that don't follow neat equations. There's a reason why, time and time again, Nobel Prize-winning economists and billion-dollar hedge funds have been obliterated by unexpected market crashes. Their models are elegant, precise, sophisticated, and completely blind to the chaos of reality. Take long-term capital management, LTCM, the hedge fund run by some of the smartest financial minds on the planet. Nobel laureates, PhDs in mathematics, a team of the best and brightest. They built one of the most complex financial models ever created. It worked beautifully until a completely unpredictable sequence of events in 1998 triggered a financial meltdown that wiped out the fund almost overnight. Genius-level intelligence, completely useless in the face of real-world randomness. Yet, despite these failures, we keep listening to experts. We keep trusting their forecasts. We keep treating their words as gospel. And when they fail, we don't learn. We just replace them with new experts, repeating the cycle. The narrative fallacy, how we invent stories to make sense of chaos. Humans hate randomness. We crave stories. We want things to make sense. That's why, when something unpredictable happens, we rush to explain it with a clear, simple narrative. We cherry-pick details, connecting the dots in a way that makes everything seem inevitable. Consider how people explain the rise of a successful entrepreneur. In hindsight, they say, they saw the future of the industry. They were fearless risk-takers. They had an unstoppable vision. But for every one of these success stories, there are 100 entrepreneurs who had the exact same vision, the exact same risk tolerance, the exact same drive, yet failed. Their stories aren't told because they don't fit the neat, satisfying narrative we want. This is why we mythologize people like Steve Jobs and Elon Musk. We treat their success as if it were inevitable. But was it? Or were they simply the lucky ones in a sea of thousands who tried and failed? This isn't to say that skill and vision don't matter. They absolutely do. But randomness plays a far bigger role than we admit. The problem is, acknowledging this makes people uncomfortable. We want to believe that the future is predictable, that hard work guarantees success, that the right strategy will always win. The truth is messier. The illusion of control, why we think we can tame the future. If you've ever watched someone at a slot machine, you'll notice something strange. They act as if they have control. They pull the lever a certain way. They press the buttons with careful timing. Some even talk to the machine, believing they can influence the outcome. Of course, the machine doesn't care. The result is random, but the player feels like they're in control. Now, zoom out. Isn't this exactly what we do in business, in finance, in politics? We create models, strategies, 5-year plans. We analyze data, hire consultants, make forecasts. We convince ourselves that if we just follow the right steps, we can control the outcome. But the truth is, the biggest events, the ones that truly change the game, are completely outside our control. Think about the leaders of major corporations in 2019. They had roadmaps, growth projections, expansion strategies. They thought they knew where their industries were heading. And then COVID-19 happened. In a matter of weeks, entire business models collapsed. Years of planning rendered meaningless by a single Black Swan event. And yet, even now, businesses continue planning as if the next Black Swan won't happen, as if the world is stable, as if the future is neatly mapped out. So what can we do? If we can't predict Black Swans, does that mean we're doomed to be victims of randomness? Not at all. It means we need a different strategy, one that doesn't rely on flawed forecasts, fragile models, or blind trust in experts. It means embracing uncertainty, becoming anti-fragile, learning how to benefit from chaos instead of being destroyed by it. And that's exactly what we'll explore next. Because while Black Swans can wipe you out, they can also make you unstoppable if you know how to play the game. If you were designing a map of the world but only included the roads you've personally traveled, how accurate would it be? You might get the outline of your neighborhood right, maybe even your entire city, but beyond that, your map would be laughably incomplete. This is exactly how traditional risk models operate. They assume that the future will behave like the past, that risks follow predictable patterns, and that extreme events are so rare they can be ignored. And yet, time and time again, these models collapse under real-world pressure. The problem isn't just that they miss Black Swans, it's that they create a false sense of security, convincing people they understand risk when in reality, they are blindly walking into disaster. Mediocristan versus Extremistan, the hidden danger of outliers. Let's start with a distinction that Taleb makes between two kinds of worlds, Mediocristan and Extremistan. Mediocristan is the land of predictability. If you randomly select 1,000 people and calculate the average weight, adding the heaviest person in the world won't change that average much. Why? Because weight follows a normal distribution, a bell curve. In Mediocristan, extreme outliers don't have a significant impact. Extremistan is the land of wild, unpredictable swings. Now imagine you randomly select 1,000 people and calculate their net worth. Then you add Jeff Bezos to the mix. Suddenly, the average net worth skyrockets. Why? Because wealth follows a power law distribution, where a few extreme values dominate the entire system. Most traditional risk models assume that the world operates like Mediocristan, stable, predictable, manageable. But real-world risks, financial crises, technological disruptions, pandemics, political revolutions, come from Extremistan, where a single outlier can wipe out entire industries overnight. Think about it. If you run an airline, your risk model might estimate an average of 2 plane crashes per year. But what happens when a global pandemic grounds your entire fleet for months? If you manage a hedge fund, your model might predict small daily fluctuations in stock prices. But what happens when a market crash wipes out half your portfolio in a single day? Risk models don't account for these kinds of outlier events. They assume the world is more stable than it actually is. The ludic fallacy. Why the real world isn't a casino. Imagine sitting at a poker table in Las Vegas. You know the rules, you know the odds, and if you're a skilled player, you can make calculated decisions based on probability. Now, imagine playing that same poker game, but halfway through, the rules change without warning. Suddenly, a royal flush is worthless, 2s and 7s are the highest ranking cards, and your chips have lost half their value. That's the difference between controlled randomness, like a casino, and real-world randomness, like financial markets, geopolitics, and technological disruption. Traditional risk models assume that the world behaves like a casino, where probabilities are fixed, rules are known, and past data can be used to predict the future. But reality doesn't work that way. Take the 2008 financial crisis. The risk models used by major banks were built on decades of historical data. They calculated the likelihood of mortgage defaults, the probability of market declines, the assumed correlations between different financial assets. But those models had a fatal flaw. They were based on the past, not on what was actually possible. They didn't consider that mortgage-backed securities could collapse at a rate never before seen, that entire markets could freeze overnight, that something outside their dataset could render their calculations meaningless. This is the ludic fallacy. The mistake of assuming that risk behaves like a game with fixed rules, when in reality, the rules are constantly shifting. The bell curve delusion, how we underestimate catastrophic risk. If you've ever taken a statistics class, you're familiar with the bell curve, the iconic shape of the normal distribution. It's a beautiful mathematical concept, and it works perfectly in Mediocristan. But in Extremistan, it's a dangerous illusion. Traditional risk models assume that events are distributed normally, meaning that extreme events, disasters, market crashes, revolutions, are so rare that they can be ignored. This is why financial analysts, insurance companies, and policymakers often use concepts like value at risk, VR, to measure potential losses. A typical VAR model might say, there's a 99% chance that the worst daily loss in this portfolio will not exceed 5%. Sounds reassuring, right? Except that the real danger lies in the remaining 1%, the possibility of a total collapse. Consider this. If you're designing a flood insurance policy based on the last 50 years of data, you might assume that catastrophic floods are a once-in-a-century event. But what if climate change makes that assumption obsolete? If you're a hedge fund manager betting on stock market stability based on 20 years of trading history, you might dismiss the risk of a total market freeze until a global financial crisis suddenly makes liquidity disappear overnight. If you're running a government forecasting the probability of war, you might use historical peace periods to justify military cuts, only to be caught off guard when a geopolitical crisis erupts seemingly out of nowhere. The problem with the bell curve is that it underestimates the likelihood of extreme, catastrophic events. It lulls people into a false sense of security, making them believe that rare disasters are even rarer than they actually are. Case study: the fall of long-term capital management. If there was ever a cautionary tale about the dangers of relying on flawed risk models, it's the story of long-term capital management, LTCM. Founded in the 1990s by some of the smartest financial minds in the world, including two Nobel Prize-winning economists, LTCM was hailed as the future of hedge fund investing. Their strategy? Using highly sophisticated mathematical models to predict market movements and make risk-free profits through complex arbitrage trades. For a few years, the models worked perfectly. LTCM made billions. Investors lined up to give them more money. Their models told them that catastrophic losses were practically impossible. Then, in 1998, the impossible happened. A financial crisis in Russia triggered a chain reaction that no model had foreseen. LTCM's safe trades unraveled at breakneck speed. In a matter of weeks, the fund lost $4.6 billion, nearly wiping out the entire global financial system in the process. The Federal Reserve had to intervene to prevent total collapse. The lesson? A model that works perfectly under normal conditions can fail catastrophically under extreme conditions. And in an Extremistan world, extreme conditions are not as rare as we think. So, what's the alternative? If traditional risk models are broken, does that mean we should abandon prediction altogether? No, but we need to change the way we think about risk. Instead of trying to predict the unpredictable, we should be focusing on building resilience. Instead of assuming stability, we should be preparing for chaos. And that's where anti-fragility comes in. The idea that instead of merely surviving volatility, we should be learning how to benefit from it. Because the only way to win in a world of black swans isn't by trying to forecast them, it's by making sure that when they arrive, we're ready. That's what we'll explore next. Because in a world ruled by uncertainty, the smartest strategy isn't prediction, it's positioning. You don't prepare for an earthquake by predicting the exact time and place it will strike. You prepare by making sure your house won't collapse when it does. This is the fundamental shift we need to make when thinking about black swans. If we can't predict them, we need to stop trying. Instead, we need to design systems, businesses, and personal strategies that don't just survive chaos, but actually thrive in it. That's where anti-fragility comes in. The idea that instead of merely resisting shocks, we should be positioning ourselves to gain from them. Because while black swans can destroy industries, fortunes, and reputations, they can also create unimaginable opportunities for those who know how to play the game. The illusion of stability: why most people are fragile without realizing it. Most people, businesses, and institutions are built for stability. They assume the world will function tomorrow the same way it did yesterday. And when a black swan hits, they crumble. Think about the businesses that collapsed overnight when COVID-19 shut down the world. Restaurants with razor-thin profit margins, retail stores that never bothered to move online. airlines that structured their entire business model around full flights and predictable demand. These were all fragile systems, built for a world that no longer existed. But some businesses thrived. E-commerce platforms exploded. Streaming services gained millions of new subscribers. Remote work startups flourished. The difference? These companies weren't relying on stability. They were positioned to benefit from volatility. So the first question to ask yourself is, are you fragile? If your entire financial security, career, or business model depends on things staying the same, the answer is yes. And that means a black swan could wipe you out at any moment. Anti-fragility, the art of gaining from chaos. If fragile systems break under stress and robust systems survive it, then anti-fragile systems go one step further. They get stronger from shocks. A classic example, the human body. Lift weights and your muscles don't just endure the stress, they grow stronger. Challenge your brain with new ideas, and it doesn't just retain knowledge, it becomes sharper, more adaptable. This is anti-fragility in action. Stress improves the system rather than breaking it. The same principle applies in business, investing, and even personal career strategy. The key is to build in a way that benefits from volatility rather than fearing it. The Barbell Strategy, balancing extreme safety and extreme upside. One of the most powerful ways to prepare for black swans is the barbell strategy, a concept Taleb emphasizes as the ultimate hedge against uncertainty. Imagine holding a barbell at the gym. On one side, you have extreme safety, things that protect you from ruin. On the other side, you have extreme risk, things with massive upside but limited downside. The middle, that's where most people operate, moderate risk, moderate returns, but it's also the most dangerous place to be when a black swan hits. Here's how this works in different areas of life. 1. Investing. 80 to 90% in ultra-safe assets, cash, government bonds, diversified index funds. This ensures that no black swan can completely wipe you out. 10 to 20% in high-risk, high-upside bets, startups, cryptocurrency, options trading, asymmetric investments. These might fail, but if one hits, the returns can be life-changing. What you don't do: put everything into safe investments that get obliterated by unexpected inflation, or go all in on high-risk bets that could go to zero. 2. Business strategy. Keep a core, stable revenue stream, but also invest in high-upside experiments. Example, a software company that has a steady B2B enterprise business, safe, while also developing an innovative AI tool that could revolutionize an industry, high upside. What you don't do: build a business that relies entirely on one revenue stream, assuming nothing will ever change. 3. Personal career planning. Develop stable, marketable skills, accounting, programming, project management, writing, but also spend time learning emerging, high-upside skills, AI, blockchain, negotiation, digital branding. The goal: if the industry shifts, you don't just survive, you already have a foot in the next big thing. What you don't do: build your entire career around a single employer or a skill set that could become obsolete overnight. The beauty of the barbell strategy is that it eliminates the middle, which is where most people suffer. When a black swan arrives, the fragile middle collapses. But if you've positioned yourself correctly, you're either safely protected or in a position to win big. Optionality, maximizing your chances of success without relying on predictions. If you had to place a bet on which startup will be the next trillion-dollar company, could you do it? Probably not. But what if, instead of trying to predict, you simply placed small bets on many different promising companies? You wouldn't have to guess correctly. Just one success could make up for all the losses. This is optionality, the idea that instead of making precise forecasts, you increase your exposure to potential positive black swans. You don't need to predict the future. You just need to be in the right place when opportunity strikes. Here's how this works in practice. Invest in multiple projects, not just one. Instead of going all in on a single business idea, experiment with multiple ventures. Network widely and keep doors open. You don't know who or what will open the next big opportunity. Stay adaptable. The most successful people aren't the ones who plan perfectly. They're the ones who adjust quickly when reality doesn't match their expectations. Case study: Jeff Bezos and Amazon's anti-fragility. Amazon is one of the best real-world examples of anti-fragility in action. While other companies were optimizing for efficiency, Amazon was optimizing for adaptability. They built infrastructure that could shift with demand. When cloud computing became a major industry, Amazon was already positioned to capitalize on it with AWS. They experimented constantly. While most of Amazon's product ideas failed, a few, like Prime and Kindle, became massive successes. They focused on growth rather than short-term profits. Instead of maximizing short-term shareholder returns, Amazon reinvested in itself, ensuring it could dominate multiple industries when the time came. Amazon didn't predict every black swan that shaped e-commerce or cloud computing. Instead, it positioned itself to benefit from whatever the future brought. The takeaway: stop predicting, start positioning. If there's one lesson to take away from all this, it's that the world will always be unpredictable. No expert, no algorithm, no model can tell you when the next black swan will hit. But that doesn't mean you have to be a victim. Instead of wasting energy on predictions that will almost certainly be wrong, focus on positioning yourself so that uncertainty works in your favor. Build resilience. Diversify your bets. Stay adaptable. Cultivate optionality. Because the next black swan isn't a question of if, it's a question of when. And when it arrives, you'll want to be ready, not just to survive, but to seize the opportunity hidden in the chaos. What separates those who crumble in the face of chaos from those who turn uncertainty into opportunity? The answer isn't luck, it's strategy. We've explored why black swans are inevitable, why traditional risk models fail, and how anti-fragility can help us thrive rather than just survive. But what does this actually look like in practice? Let's dive into real-world case studies that illustrate how different individuals, businesses, and industries either collapsed under the weight of the unexpected or turned crisis into an advantage. 1. Amazon, the anti-fragile empire. Most companies try to predict the future. Amazon does something smarter. It builds systems that can adapt to whatever the future brings. In its early days, Amazon was just an online bookstore. But instead of limiting itself to books, Jeff Bezos focused on building infrastructure, warehousing, logistics, and cloud computing. This wasn't about predicting what would happen in e-commerce. It was about making sure Amazon was positioned to dominate whatever happened. How Amazon benefits from black swans. AWS, Amazon Web Services. Originally, Amazon needed cloud computing for itself, but instead of keeping it internal, they turned it into a business. Today, AWS generates billions in revenue, making Amazon less dependent on retail sales. COVID-19 acceleration. When the pandemic shut down physical stores, Amazon's business exploded. While traditional retailers struggled, Amazon's warehouses, delivery networks, and cloud computing services were already in place to absorb the demand surge. Experimentation and optionality. Amazon constantly launches new projects, knowing that most will fail. But the few that succeed, like Prime, Kindle, and Alexa, become massive industry disruptors. Lesson: instead of making specific predictions, Amazon built a company that could pivot and capitalize on any market shift. 2. The 2008 financial crisis. Why traditional risk models fail. Before 2008, the financial world operated under the assumption that markets were stable, mortgage defaults were predictable, and risk could be managed through diversification. Banks, hedge funds, and rating agencies relied on models that assumed extreme market crashes were rare, so rare that they were ignored. Then reality struck. A housing market collapse triggered a global financial meltdown, exposing just how fragile the entire system was. The same risk models that were supposed to prevent disaster actually encouraged reckless behavior because they made firms believe they were protected. Why it happened. Banks over-leveraged themselves based on flawed models that underestimated risk. Investors assumed mortgage-backed securities were safe because they were rated highly by agencies that relied on past data rather than real-world uncertainty. When a black swan event hit, a nationwide collapse in home prices, the entire financial system unraveled overnight. Relying on past data to predict risk is dangerous in Extremistan. Instead of blindly trusting models, companies should focus on resilience, low leverage, diverse revenue streams, and strong liquidity buffers. 3. The COVID-19 pandemic. Winners and losers of a global black swan. The pandemic was a textbook black swan event. Highly unpredictable, globally impactful, and rationalized in hindsight. Some businesses were crushed instantly while others adapted and thrived. The fragile. businesses that collapsed traditional retail. Companies like JCPenney and Neiman Marcus collapsed because their entire business model relied on physical stores. They had no contingency plan for a world where foot traffic disappeared overnight. Restaurants with no digital presence. Many independent restaurants folded because they lacked online ordering, delivery infrastructure, or financial resilience to survive months without income. Travel and hospitality. Airlines, hotels, and cruise lines operated under the assumption that demand would always exist. The shock was so severe that even government bailouts couldn't fully stabilize the industry. The anti-fragile. Businesses that thrived, Zoom and remote work software. Video conferencing wasn't a high-growth industry before COVID, but the sudden shift to remote work turned Zoom into a household name overnight. The company was ready for an unpredictable shift. E-commerce and delivery services. Businesses like Shopify, Instacart, and DoorDash capitalized on the sudden shift in consumer behavior, scaling their operations to meet demand while traditional retailers floundered. Pharmaceutical and biotech firms. While most businesses suffered, companies like Pfizer and Moderna had the R&D and manufacturing capacity to pivot quickly and develop vaccines in record time. Lesson: when uncertainty strikes, agility and digital infrastructure can make the difference between collapse and dominance. Before, Bitcoin, the ultimate Black Swan asset. When Bitcoin was first introduced, it was dismissed as a niche experiment, a curiosity for tech enthusiasts and libertarians. But over time, it became something more, a hedge against the fragility of traditional finance. During the 2008 financial crisis, governments responded by printing money and bailing out banks. This led to concerns about inflation and systemic fragility, exactly the conditions that Bitcoin was designed to counteract. How Bitcoin thrives in uncertainty. Decentralization. Unlike traditional currencies, Bitcoin isn't controlled by a central authority, making it immune to government mismanagement or monetary policy failures. Scarcity. With a fixed supply of 21 million coins, Bitcoin resists inflationary pressures that weaken traditional currencies. Crisis hedge. Whenever financial instability rises, Bitcoin adoption spikes. It became a store of value during the Greek debt crisis, the COVID market crash, and as inflation surged post-pandemic. Lesson: Black Swan events can create entirely new asset classes, but only for those willing to take asymmetric bets. Number 5. Personal career adaptability, the freelancer advantage. While businesses collapse during Black Swans, individuals also face career disruptions. The rise of AI, automation, and remote work has obliterated traditional career paths, but it has also created new ones. Consider a mid-career marketing professional in 2010. They likely built their career on traditional media, billboards, print ads, TV commercials. But by 2020, digital marketing had completely transformed the industry. Those who ignored the shift lost relevance. Those who adapted to SEO, social media, and data-driven advertising thrived. Similarly, the rise of AI tools like ChatGPT is disrupting knowledge-based jobs. The fragile professionals are those who assume their skill set will always be relevant. The anti-fragile ones are those who constantly reinvent themselves. Lesson: the safest career strategy isn't stability, it's continuous reinvention. Final takeaways. How to apply Black Swan thinking. We've seen examples of businesses, industries, and individuals either collapsing under the weight of uncertainty or turning Black Swans into opportunities. Now it's your turn. Stop predicting, start positioning. You don't need to know the future, you just need to be ready for multiple futures. Build for anti-fragility. Whether in business or personal finance, structure your life so that shocks make you stronger, not weaker. Embrace the Barbell Strategy. Combine extreme safety, stable income, diversified assets, with extreme upside, asymmetric bets, high-risk ventures. Maximize optionality. Keep doors open, explore emerging industries, and never rely on a single source of income or opportunity. Adapt fast and stay nimble. The winners of the next Black Swan won't be those who saw it coming. They'll be those who adapted first. Because in a world where uncertainty is the only certainty, survival isn't the goal. Thriving is.